Hi, good morning, everyone. Welcome to our Phillip Securities Research Weekly Morning Call. Today, we have a few stock counter updates, including the Phillip on the ground on Zoom video, as well as results from DelMonte and LHN. Some technical analysis, as well as our usual, FAANGM monthly and the usual Singapore weekly for our macro or sector outlook. And just as a reminder, this will be our last weekly morning call for the year, and we will resume on 9 January 2023 at 11 a.m. So without further ado, I'll hand over my time to John to kickstart the presentation. Thank you.
Thanks, Max, and good morning, everyone. So for today, I'll be sharing on our usual monthly publication for the FAANGM for the month of November. Next slide, please. So just a brief update on performance for November. The FAANGM was up 2.7%, lagging both the Nasdaq and the S&P 500, which was up 5.4% and 5.5%, respectively. Amazon and Apple were the laggards, so they were down 5.8% and 3.5%. While Meta was the biggest gainer, it was up almost 27%. This mainly came as on the news of employee headcount reduction and other cost-cutting initiatives by the company. So overall, I think that FAANGM earnings yields are starting to look a little bit less attractive, especially versus the US 10-year. There's quite a bit of uncertainty surrounding earnings growth for 2023. As well as shrinking margins across most of the FAANGM companies. As such, we downgrade our rating from an overweight rating to a neutral rating. Next slide, please. So this is a chart of the FAANGM earnings yield versus the 10-year spread. Basically, earnings yield is the inversion of your PE ratio. So it's just earnings per share over price. You can see that right now, or rather for most of this year, the FAANGM earnings yield has kind of declined compared to the US 10-year. A big reason, obviously, is because interest rates have been rising. The 10-year has been rising at such a fast rate. So we do think that, and this is not just the FAANGM, but the whole tech sector, the Nasdaq as well, is a very similar story. We do think that right now it's looking a lot less attractive than I guess just your fixed income. If you were to just buy a US 10-year treasury, pretty much, I guess, in terms of earnings yield, you'd be getting a more positive earnings yield compared to the FAANGM. We do expect this to be somewhat suppressed moving forward, because the only real way that this can there are only two real ways that this can kind of turn. One would be the 10-year treasuries starting to reduce a little bit, and two would be a rapid expansion in earnings growth again, which doesn't really seem likely for next year. Yeah, so moving on to some of the news for the FAANGM companies. In terms of Meta, they cut 11,000 jobs, and this represents about 13% of their workforce. They also said that they would be extending its hiring freeze through to at least the first quarter of 2023, and will continue to cut some of their discretionary spending. This comes in line as operating margins were down about 16% year-on-year for the third quarter of this year. Meta is also exiting a lot of their non-core projects, or rather projects that they deem to be non-essential. One of which is actually their Portal Smart Display business. And another is actually, they were actually working on a smartwatch project, but they've since basically shut down all developmental work on that. At the same time, they've also declined their option to renew more than 250,000 square footage of office space in New York. So that's quite significant. And this, their current lease runs through to 2024. So obviously, most of the news is surrounding a lot of their cost-cutting initiatives, which should hopefully expand margins moving forward. And that should be a positive for the company. Moving on to Netflix, they're starting to move into live broadcast. So they're actually debuting this live broadcast with a comedy special by Chris Rock early in 2023. This kind of comes as its other video on demand streaming players have also moved into live sports in a kind of effort to generate a little bit more subscribers, a little bit different type of subscribers than what they're used to. In terms of streaming, it continues to maintain its top spot in US TV usage. This is for the month of October. So streaming was up on the 8th month, reaching about 37.3%, compared to about 33% of cable. In terms of streaming, Netflix is second at 7.2%, with YouTube still leading at 8.5%. Moving on to Alphabet. So quite a similar story for Alphabet. For the last 3 months, they got fined again. Or rather, they reached an agreement to pay out $391 million to 40 states in the US, and this is based on alleged location tracking breaches. So the states allege that Alphabet actually misled users into thinking that they turned off location tracking while still collecting their information. In terms of the fines year to date, they've been fined almost about $3 billion, which represents about 1.5% of their year to date revenue. So that's it for my companies. I'll pass it on to Max and Ambrish to continue on. Thank you.
Thanks, Jonathan. So I'll move on to Apple. Firstly, as we all know, Apple faced an iPhone production disruption because of the lockdown in China, where the Foxconn's facility entered into a week-long lockdown in early November. And the facility actually produces around 80% of the global iPhone 14 Pro models. So the Foxconn actually entered into a closed-loop system, whereby workers were required to stay at the factory and were not allowed to leave the facility. But some actually refused to return to work, and some others actually decided to escape the site instead. So because of this, Apple has issued warnings to customers saying that they may face a longer waiting time to receive their orders. Yeah. So the second news for Apple is that the lawsuit between Epic and Apple took its next step in the US Court of Appeal. So just as a refresher, Epic sued Apple alleging that its App Store is operating under a monopolized market, and it wants Apple to allow third-party software marketplace to serve the same purposes for Apple devices. So last year, the district court actually said that rejected the claims made by Epic. But the new challenge for Apple now is the Emergence of Justice Department, which, although maintains a neutral position, it shares a lot of similar concerns with those of Epic's. So the decision for the latest proceedings is expected to come out within a year, and it is likely to get appealed to the Supreme Court, which is the highest level of the court in the US. So the iPhone production disruption is definitely concerning for Apple because it comes at a quarter where it coincides with the holiday season, and it is also the first quarter following the launch of Apple's latest iPhones. So although the sales number of the December quarter is likely going to be affected, we feel that Apple should be able to recapture some, if not all, of those sales in the subsequent quarters, because the company enjoys a strong customer loyalty, brand loyalty, whereby they are willing to wait despite the extended waiting time instead of simply switching to another smartphone brand. Yeah, so moving on to Amazon. Firstly, Amazon confirmed that it is cutting jobs for its corporate ranks, and the layoffs could affect around 10,000 employees, or around 3% of its corporate staff in the retail, devices, and HR divisions. And this layoff is unlikely going to affect its warehouse workers. So this is part of the business review where it has targeted unprofitable teams or projects, and the devices unit, which is responsible for its famous Alexa devices, has fallen under this category because it has been losing more than $5 billion annually. So Amazon is currently working closely with the employees who are affected, as they offer severance packages as well as helping them find new roles both inside or outside the company. And then the second news for Amazon is that it is closing its three of its ventures in India, which includes the food delivery, education tech businesses, as well as one of its wholesale e-commerce website. Amazon is closing its Amazon Distribution, which is a B2B e-commerce platform that is targeting small shops that sells household items. But its Amazon Business, which is a bigger wholesale B2B platform for small businesses in the IT, hospitality, and education sector, remains available and unchanged. So the closure can be due to the growing hostility of Indian government towards Amazon or its other US tech peers as well. And it may also be partly due to the Amazon's effort to rein in the cost as part of its business review. So with that, that's all from me. I'll hand over my time to Ambrish to talk about Microsoft. Thank you.
Thank you, Max. So moving on to Microsoft, Microsoft, it has agreed to acquire Activision Blizzard for about 69 billion US dollars. However, over the last few months, the merger deal, it has been under pressure, mainly by its competitors, Sony and antitrust regulators, because of the concerns that the merger deal, it could lessen competition in the gaming industry. However, we think that the deal might get approved mainly because Microsoft is planning to offer concessions to its competitors, like mainly because it has offered a 10-year licensing agreement for Call of Duty, the popular game, with Sony and Nintendo, as well as it is not planning to make the content exclusive to Microsoft. However, if the merger deal it is blocked, Microsoft will pay a 3 billion breakup fee to Activision. And moving on to the second news, Microsoft, it declared a quarterly dividend of $68 per share in November. It will be paid to shareholders on March 9th and to the shareholders of record as of February 16th. And the ex-dividend for date is February 15th. Overall, we remain positive on Microsoft, and despite the near-term uncertainty and slowdown in the PC business, we think that Microsoft, it enjoys tailwinds from two key areas, mainly its Azure cloud business, as the companies they digitize operations, as well as its Office 365 offering, which helps companies to manage tasks and projects. So that's all for Microsoft. I would now like to pass on to Jonathan for the conclusion.
Thanks, Ambrish. I think you meant to say 68 cents instead of $68 for dividends. But anyway, just to conclude, like I mentioned earlier, we do think earnings yields are starting to look less attractive. There's a lot of uncertainty surrounding earnings growth for next year, so a little bit more selective on I guess within the FAANGM group of companies. We do think that the long-term secular tailwinds for cloud cybersecurity and streaming services still remain intact and actually are thriving quite well. So that should bode well for Microsoft and Netflix. But we do think that a lot of near-term uncertainties, especially in digital advertising and continued supply chain issues for hardware, should continue to affect the rest of the FAANG companies like Meta, Alphabet, Apple, as well as Amazon. Yeah, so that's all for our FAANGM monthly. I'll move on now to Zoom. They actually held a presentation with us last week, so I'll just be sharing a little bit on what they had or what they shared. Just a reminder that Zoom is actually not rated. So we're just providing some sort of an update on it. In terms of their third quarter 2023 results, revenue grew about 5% year on year. In terms of constant currency, this number was about 7%, so really not that much difference. In terms of PATMI, this number contracted by 86% year on year, mainly due to increased expenses in sales and marketing and R&D. One of the main things from Zoom is that they're actually kind of focusing more on their enterprise revenues and their enterprise customers, which have seen a 20% year-on-year growth in revenue. Enterprise customers has also grown about 14%, and the large customers that contribute more than $100,000 in annual revenue grew about 31%. So what they're actually trying to I guess what they're trying to do in terms of business model, firstly, is to expand their total addressable market. So they've actually included or introduced and are actually putting quite a bit of R&D into developing a product that is for contact center use. So what this does obviously is that you kind of enter a market and you can I guess offer a product that is cheaper than what is already out there with the infrastructure that they have. This kind of opens up their potential revenue stream to a much wider audience, especially a more B2B audience instead of B2C audience, which is a little bit, I guess the churn rate for B2C is a little bit higher and a bit more unstable. At the same time, Zoom was able to kind of increase their average contracts, which now stands at about 16 months. So they've been increasing it quarter on quarter for the last 8 or 9 quarters. And this also improves quite a bit of stability in terms of revenue. And what's also very interesting is that 10% of enterprise customers who use 3 or more products generate about 50% annual recurring revenue. So what they're trying to do is, or what Zoom is trying to do is to cross-sell a lot of their enterprise products to their enterprise customers. In terms of their full year guidance for FY23, they do expect revenue to be about $4.375 billion, which is about a 7% year-on-year growth. In terms of their non-GAAP earnings per share, this number comes in at $3.92, which is about a 23% year-on-year decline. If you just take their GAAP EPS, I believe this number is roughly going to see like a 75 to 80% year-on-year decline. This mainly because they actually spent quite a little bit of money this year on R&D and sales and marketing. So that's all for Zoom. I'll now hand my time over to Glenn, SGX. Thank you.
Thanks, John. So for SGX, this is more of an update using with their market statistics that they release. They only release half-yearly results, so we don't have any results to analyze. So anyway, moving on to the first slide. Yep. So based on their securities volume, if you look at the first graph on the top, it's trending downwards with the 5-month FY23 securities daily average volume, or SDAV, down 10.5% year-on-year at 1,095 million contracts, as the market sentiments remain subdued due to the macroeconomic factors, as well as the volumes moderating from a record year in FY22. However, you look at the second chart at the bottom, SGX's derivatives volume is trending upwards, and with the 5-month FY23 derivatives daily average volume, or DDAV, up 9.4% year-on-year. And as the market volatility continues to rise, derivatives volume can climb for the rest of FY23. And this is good for SGX, as this would mean higher revenue on their derivatives side. Moving on to the next slide. So for the treasury income, it dipped in FY21 and FY22. And, this is, I think the previous slide, I think skip one slide. Yeah, treasury income. So treasury income, it dipped in FY21 and FY22, and this was mainly due to the low interest rate environment. However, we expect a rebound in treasury income in FY23 by at least 8%. So if you look at the chart on the left, we can see that SGX's treasury income is lagging behind the Fed fund rate. So the Fed fund rate is the red line, while the treasury income would be the blue bar. So you can see in 2018-2019, the Fed funds rate was at around 2.5%, but the interest rates only kicked in and they saw a sharp spike in their treasury income in 2020. And this is due to a majority of their collateral balances, which at FY22 was 13.9 billion, are placed in fixed deposits with the tenure spread out. Hence, certain deposits have not matured yet and the interest rates have not been refreshed. So nonetheless, moving into FY23, we should expect the treasury income to recover to pre-pandemic levels or even higher as they get placed into higher interest levels, higher interest fixed deposits. So for some context, in FY20, SGX earned a yield of 98 basis points on collateral balances when the Fed fund rate peaked at 2.5%. So we should expect to see this even higher as the Fed fund rate now is above 4%. Moving on to the next slide. So for their derivatives pricing, their equity, currency, and commodities derivatives average clearing fee per contract, or in short, their derivatives pricing, it reached new highs at $1.62 in the first quarter of FY23. So this would be the red line. And the uptick in derivatives pricing is mainly due to the product mix of the derivatives being traded. And this is encouraging, and we should actually continue to see the derivatives fee continue to trend upward. However, their securities average clearing fee per contract, or the securities pricing, the blue line, it's only at 2.58 basis points in the first quarter, and this was only marginally higher than the FY22's average clearing fee of 2.56 basis points. We should expect this to maintain at these levels going into FY23. However, the boost in their derivatives pricing should more than cover for their rather flattish securities pricing. As such, we maintain a buy with an unchanged target price of $11.71. Our estimates remain unchanged, and our target price also remains pegged to +2 standard deviation of its 5-year mean, or 26 times PE. And the catalysts for SGX include continued growth from the derivatives volume and fees, as well as higher treasury income as the higher interest rate starts to kick in. So that's all I have for SGX. I'll now hand it over to Darren.
Thanks, Glenn. So we hosted a Sabana REIT last week. It was a bonus webinar, so these are some of the highlights of that webinar. So Sabana REIT is a relatively small REIT, about $475 million market cap. It's an industrial REIT with assets in Singapore. So the portfolio occupancy for third quarter 22 is 89.1%. It's just a business update, so they didn't have any financials to go with it. And actually, they are going through AEI for one Tuas Avenue 4. So if you don't include that, the occupancy is actually at 92.1%. So for Sabana, they positive rental reversions of 10.2% came in for third quarter 22, following the trend of strong positive rental reversions in second quarter 22, which came in at 17.4%. So they had 10 positive quarterly rental reversions in the past 11 quarters. So on the capital management front, the aggregate leverage is at 33.7%, of which of their debts, 73.3% of them are hedged to fixed rates with an weighted average debt tenure of 2.2%. They do not have any refinancing obligations until 2024. So for their strategy, they are planning to build a value proposition for their tenants through asset enhancement initiatives and refurbishment, like upgrading the lobby and the toilet, etc. They are also confident for higher positive rental reversions because the renewals will be based on 2020 rents. Like their WALEs are usually they sign for 3 years. So 2023 will be based on the 2020 COVID level rents. So they are expecting some positive good rental reversions there coming going forward. For the outlook, there is still strong demand for logistics, but the warehouse demand is tapering off, especially those relating to the government stockpiling, especially during the COVID time. There is also a slowdown in manufacturing, primarily from the electronics components sector, as there is an oversupply of chip makers who can't export into China due to political issues rather than fundamental issues. There's also more industrial supply coming in 2024. As government in the second half of 2022, they increased the available and confirmed sites by almost 40% compared to the first half of 2022. And usually these industrial properties take about 2 years to complete. Sometimes they also mentioned that sometimes they do have to compete with JTC, and how they do that is to just be not near where JTC is. And many government sites are available in Tuas, so they try to avoid the Tuas area. And Hyundai is they have a manufacturing plant in Singapore that is under production. So how this will benefit the industrial properties is that there will be an influx of manufacturers and peripheral industries. So this will benefit the Sabana REIT as well. Next slide. Yeah, so this is just an update on Prime US REIT. Yeah, so the reasons why we like Prime US REIT, first of all, is because they have a resilient portfolio and there is a jump in their leasing volumes. So for the third quarter 22, they signed almost the first half amount. Like they signed 246.2k square foot, close to the previous 2 quarters combined, of which 52% are new leases, and the demand is coming from the communications, legal services, real estate services, education, and food services sector. And for the third quarter, they continued the trend of 10 positive consecutive quarters of positive rental reversion. So the third quarter came in at positive 10.1%. And their in-place rents is still 6.7% below the asking rents. So going forward, there's still potential for more positive rental reversions. They are also very diversified through their tenants and their assets. So they have no primary market contributing more than 11.8% of cash rental income and no single property contributing more than 13.7% of CRI. Their portfolio occupancy remains stable at 89.6% despite one of the big tenants leaving because they signed some of the vacant assets, vacant properties. So because of that lease, the kind of the new leases offset the Brown, Brandon Brown, leaving the Western Square. They also have a WALE of 4.1 years and with well staggered lease expirations. 73% of their tenants are in established and growth sectors, STEM and TAMI sectors. So in the rising interest rate environment, a REIT will definitely want to be highly hedged to fixed rate. So for Prime, 83% of their debt is on fixed rates, with 66% of the total debt hedged through 2026 and beyond. They do not have any financing obligations until 2024 July. And for sensitivity analysis, every 100 basis points increase in their rates in interest rates would affect their FY22 estimated DPU by about 1.5%. So according to JLL, office re-entry levels reached a post-pandemic high in the second half of September, and the remote work is showing signs of losing momentum as the labor market tightens. So with that, we maintain our buy call on Prime US REIT with a target price of 88 cents. And at this target price, the DPU yield is about 14.6%. And right now it's trading at about 40% discount to book value. Historically, it's been trading around 0.9 times to about 1 times the book value. And some of the catalysts include improved leasing and a greater return to office for Prime. Yeah, so that's all for me. With that, I will hand over the time to Terence.
Thanks, Darren, and good morning, everyone. CDL latest results were lifted by hospitality and divestment gains. In our next slide, the Copen Grand executive condominium was fully sold within a month of launch. This Copen Grand EC was launched in October 2022. The 639 units was fully sold at $1,300 PSF. So we estimate that this $1,300 PSF gives it a comfortable 25% margin at a for the group. The hospitality segment also continued to benefit from pent-up demand. RevPAR surged 110% year-on-year, and this was driven by average room rate and occupancy increases. Last but not least, the healthy gearing levels continue to boost the ability of the group to replenish the land bank. Group's net gearing remains stable at 83% for 3Q22. This was unchanged from first half 22, with interest cover at 12.1 times. This was 60.5 times for first half 22. The main reason why there was a drop was because of the dividend distribution. In our next slide, in terms of the negatives, residential sales slowed in third quarter 2022 as lower inventory rate. So if you look at the table here on your left hand side, you can look at the current projects for CDL. You can see that most of them are the average units sold, based on the last column here, is hovering around like 85 to 88% fully sold. So because they don't have a lot of inventory left, so the residential sales consequently slowed. But in terms of the outlook, the successful launch of Copen Grand EC bodes well for its other EC in the same vicinity. They have another EC in the Bukit Batok region, so they expected to be launched next year. So the successful launch here will likely help to support the prices in the new development. Its strategic review of the global hospitality portfolio, MNC, will also reduce the RNAV gap with the price. So in terms of recommendation, we maintain accumulate on CDL with an unchanged RNAV TP of $8.86. CDL is trading at an attractive 40% discount to our RNAV of 1364. So that's all for me for CDL. My next counter is SETS. For SETS, we believe the further funding clarity will reduce the overhang on the stock. In our next slide, the SETS has provided more details on its funding plan for the proposed acquisition of Worldwide Flight Services. The $700 million in term loan will comprise a 3-year euro-denominated term loan with an all-in cost of 4 to 4.5% per annum based on the prevailing Euribor. So if you to recap, if you look at for SETS, they actually provided more clarity on their funding update in their last announcement. Essentially, this $1.8 billion, if you look at the chart here on your right hand side, this $1.8 billion will be funded by a rights issue not exceeding $800 million. And the rest that was initially slated to be a placement will now be split between a term loan and internal cash. So this term loan of $700 million is actually now denominated in euro with a lower cost of funding versus what we thought initially. And then the rest is internal cash flow. The proposed rights issue is also expected to be launched in the first quarter of 2023, subject to shareholders' approval of the proposed acquisition at an EGM. So in terms of some of the positive with regards to the latest announcement, we think that there's lesser concern on the discount of rights, which was holding down the stock previously. The reason is that with access to this acquisition bridge facility and the rights issue fully underwritten by the banks, we do not expect the discount for the rights to be steep. SETS had also previously obtained an acquisition bridge facility at 1.2 billion euros to fund the proposed acquisition. So what we are trying to say here essentially is if the market is not conducive for the rights, SETS could also choose to undertake the rights issue at a later time. They don't have to undertake the rights issue just to complete the acquisition. The $700 million euro term loan at 4 to 4.5% was also lower than our initial 5.5% that we penciled in into our model. We also view the term loan positively as it provides a natural currency hedge, and it's also lower than what we previously modeled. In our next slide, in terms of the recommendation on SETS, we downgrade SETS to neutral because of the recent run-up in the price. So this moved the current share price very close to our target price. But what we did was to increase the target price slightly from 302 previously to 308 as we lower the funding cost for WFS. We peg SETS to 18.5 times FY24 earnings, which is one standard deviation below its historical range. We still like SETS because we believe SETS is at an inflection point and expect break even by second half financial year 2023. So that's all for me for SETS. My last counter is Pan United. The construction recovery was slower than expected. So they didn't provide any third quarter results because of the half yearly reporting. But when we look at some of the BCA statistics, demand for ready-made concrete for first 9 months of 2022 was 8.8 million cubic meters, about 8% lower than our estimate, but was higher than 2021. In terms of some of the positives, construction progress payments for the first 9 months of 2022 rose 14.2% year-on-year. This was lifted by border restrictions. So construction progress payments is an important metric for us because it tracks the work, the progress made, the billings made for work completed. So for first 9 months 2022, we see this rising faster than the contracts awarded. You can see this in figure 2 here. And this we believe was the result of more foreign labor in the market. But in terms of some of the negatives, the workplace fatalities hampered overall recovery. As of 1st September 2022, the number of workplace fatalities stands at 36, and this was up from 28 for first half 2022. The resulting is the heightened safety period being imposed, which has seen timeouts and punitive measures imposed on the sector, leading to slower construction progress. The slower construction progress has also resulted in contracts awarded for the first 10 months of 2022 to be 9.4% weaker than 2021. In terms of outlook, thanks. The construction sector is expected to be weighed down in the near term by higher operating costs, but we believe the tailwinds remain intact. The prospects of the local construction industry is expected to be weighed down by skilled labor and energy. One positive though is construction material costs have stabilized in 3Q22 after surging in first half 22. So if you look at the chart here on your right hand side, you can see that in the first half of 2022, you see RMC surging, and this was really a result of the higher cost of raw materials like sand and freight. But in the last 6 months, it's kind of stabilized now. And despite all these near-term headwinds, we see the recovery remaining intact. This is really driven by the higher number of HDB BTO flats that have been launched. So with that, we maintain our buy rating with unchanged target price of 54 cents, but we trim FY22 and FY23 earnings by 12% and 11% respectively on account of the heightened safety period imposed. Our target price is still based on 12 times 22 earnings, which is a 20% discount to its 10-year historical PE on account of the still uncertain business environment. So that's all for me for PenU. I'll hand over the time now to Zane.
Thanks, Terence. Good morning, everyone. So now I'll be talking about the technical analysis section. For Straits Times Index, this week we could see a possible continuation of the pullback if the 3,220 level is being breached. So last week what we did was, after we rejected off the 3,300 level, we tested a swing low at 3,220. So currently we are moving in a bit of a sideways direction. So we need to know whether 3,220 can hold. If not, we could see further downside to the next support at the 3,140 to 3,180 area, which is the 38.2 to 50% Fibonacci retracement level. That will actually fill a price gap and also retest the key uptrend support line. The key immediate resistance will still be at the 3,300 to 3,310 zone. Next slide. For S&P 500, we could see a possible continuation of the pullback as well. This was because last week we rejected off the key downtrend resistance line at the 4,030 to 4,130 resistance area. So with a fresh bearish crossover on the MACD registered last week, we could see further downside to the immediate support at 3,008 to 3,930 level, which is the 38.2 to 50% Fibonacci retracement levels. That will also fill a price gap earlier on. So that's for S&P 500. Next slide. So this is a slide on this year's sector analysis for the US market. So this year has been relatively rough. The S&P was down from the January peak to the year low level in mid-October was down about 27%, and currently is down about 17% year to date. So looking at some of the winners and losers for this year, the main winners were, the number one was in energy sector, which was the noticeable standout. The top performing stocks were in Occidental Petroleum, was up about more than 120% year to date. The giants, ExxonMobil and Chevron, were also up about over 60% and 40% year to date respectively. The second sector that we saw a lot of green in was the healthcare sector in the middle of the left diagram. So the drug manufacturers performed better than overall index, with the standouts being Merck and Company, Eli Lilly, and also Bristol Myers, which gained about 30 to 40% year to date. Amongst the industrial picks, the aerospace and defense sector remained well in the green. So some of the notable top gainers were like Northrop Grumman, up about 37%, and Lockheed Martin, up about 36%. And then last but not least, when you look at the top right corner of the diagram, the consumer defensive sector also performed slightly better than the broad-based index. So the gainers came from about the packaged foods, beverages, and discount stores sectors, with names like Coca-Cola, PepsiCo, and Walmart were some of the gainers for this year. As for the losers wise, the top losers were in technology, software, semiconductors, and communication services, deep in the red, as you can see in the diagram. So some of the notable losers were Meta Platforms, down about over 60% this year. AMD and Nvidia down about 50% this year. And when another losers were consumer cyclicals. They underperformed compared to the overall index due to the slowing economic growth. Some notable losers were Amazon down 47% year to date and Tesla down 48% year to date. Last but not least, the banking sector was also dragged down by the investment banking business. So Citigroup led the banking sector down about 25% year to date, and peers such as Bank of America and JP Morgan were also down about 25% and 16% year to date. So when we look at the diagram on the right, this actually shows the 11 SPDR sector ETFs as compared to S&P 500 index. So when we look at the performance of them year to date, the trends are actually reflective of the fact that value stocks such as those from the energy sector and defensive sectors like the consumer staples, XLP, utilities, XLU, and healthcare, XLV, remain relatively strong this year, even though some were marginally down from the previous year as compared to the big losers such as the communication services, XLC, consumer discretionary, XLY, real estate, XLRE, and of course, technology, XLK. Next slide. So looking forward next year, which sectors could actually outperform next year? So when you look at the chart wise, the utilities ETF XLU actually has a good chance. So for most part of this year, while its peers have been in a downtrend, it's been trading mostly in a range. So if it does test the year high resistance around the $78 mark, that will represent about 10% potential upside for utilities ETF XLU for next year. Next slide. Another potential winner could actually lie in the financials ETF. So that's XLF. So for XLF, this year, what it did was a possible double bottom formation around the $30 mark. Then its current resistance level is near the $35 to $36 level. So if it were to break out of this resistance, it could actually test the swing high around the $41 mark, which is confirmed the double bottom projected target. So that's about a potential 15% upside for XLF going to 2023 if it does break out of this resistance zone. So we like these two ETFs that could bring potential returns next year. Next slide, please. So for individual stocks, first one I have for this week is DraftKings. So for DraftKings is a technical buy at $15.76. The take profit levels can be set at $21.40 and $27.50, with the stop loss at $13.30. The stop loss closed at $13.96 on Friday. For DraftKings, there's a potential breakout of this bullish cup and handle formation to actually retest the resistance zone at 2580 to 2850. So this trade will be valid if it's managed to break out the handle downtrend in the near term, with the MACD creating higher lows while the price making lower lows. There's also bullish divergence present with signals for increasing momentum. So it could actually retest the first resistance zone first at 1980 to 2140 before it hits to the next resistance zone mentioned earlier on, where the 2750 swing high level is actually confirmed with a previous support level, now turn resistance. And it also matches the projected target of the cup and handle breakout. Next slide. So the other one is Capital DC REIT. For this, we have a technical buy at 190, take profit level at $2.05, the stop loss at $1.84. The stock last closed at $1.89 on Friday. So for Capital DC, it has been consolidating in a bullish ascending triangle, retesting the previous support, now turn resistance level at $1.90 multiple times, forming higher lows in the process. The Bollinger Band is also contracting currently, so we are likely to see an expansion in volatility soon. And a potential breakout of this 190 horizontal resistance could bring the price to retest the next resistance level at $2.05, confluent with a previous swing high level and also a downtrend resistance line. So that's all from me for the technical analysis section. I'll pass on my time to Paul to talk about DelMonte results.
Yeah, thanks. Thanks, Zane. So move on to DelMonte's results. So for the results, they reported record margins from price increases. Next. So despite the rising raw material cost, packaging costs, logistics, they managed to report strong gross margins at the record level. So the results was better than expected. It was 67% of our FY23 forecast. So it's supposed to be around 50%. The reason is because the margins hit 29% mentioned. So in terms of the positives, the gross margins was because of I think they raised prices by 3 times over the past 18 months in the US. So you look on the left, you can see that the PAT for DMFI, which is actually US operations, is up 66%. The other thing is there was a sharp rebound in sales in the Philippines. The revenue rose in the second quarter 22% in peso terms. But because of the currency in US dollar terms, there was a big drawdown in US dollar terms. It was only up 5%. Some of the reasons why Philippines rebounded is because if you recall in the prior quarter, first quarter, there was a change in distributorship. So we think this isn't really reflecting the actual consumer demand, but more a bit of a channel restocking because they changed distributor, so you destock one and you restock the other distributor. In terms of the negatives, is the one overhang for this stock is going to be the debt. So the debt rose another 500 million to 2 billion net debt. And one of the reasons is because the debt increased because number one, the inventory rose 366 million year on year to 1.2 billion. In part, of course, it is due to Christmas, but again, you have the similar thing last year, but also because of the high raw material price, they were stocking up more for better sales, and of course, also in the event there's any supply chain issues. There was also another 70 million for the purchase of kitchen, but basics, which is more into the broth segment. This is a new category that they're looking to grow. Then in terms of the outlook, they will continue to be another second half. We think there'll be another year of second half will be growth because of the increase in prices in September. So you're going to get the benefit of it in the following quarters. And also, they're also going to have another round of price increase in February. One thing about DelMonte US products is almost 3/4 of it is priced less than $2. So it is a consumer staple, affordable as a value option for households in the US, especially now that they dine out less and they dine in more in this current inflationary environment. For Philippines, we still think will be a bit more, the growth will be a bit more muted because of the weak consumer environment. We maintain a buy with a slightly lower price because we lowered our PE from 10 to 8 times, although we raised our earnings by 19%. So the stock is trading at a 50% discount to the industry. The report has the industry valuations here, and also it's trading now about 4 times PE and 8% dividend yield. Next slide. Move on to LHN second half results. Co-living is the main growth driver. So co-living in this environment where rent is up about 20% this year. So I mean, those who are looking to rent, I think you all understand there's a dearth of projects, a dearth of available supply. So they are one of the beneficiaries. So in terms of the results, it was below our expectations. It declined 19% year on year, and because they discontinued a dormitory business that was set up during the pandemic in May of 2022. So you're going to get at least 12 months of impact from this. So the positive is the co-living. So co-living revenue jumped from higher rental rates, which we think is probably at least 10 to 20, at least high mid-teens to 20% jump in rental rates, and also 25% room capacity increase. There will also be new capacity additions. So they added the main one they added all these new locations. That was what drove the increase in capacity. The one that dropped down was because of the dormitory business. Because they exited from it. Then this one will drag down, and the earnings was down about 37%. The net debt is up partially because they made acquisition, but it's not totally an issue because they got 2 years of they already fixed their interest rates for 2 years. In terms of the outlook, we are looking at maybe a 10-15% growth because of the absence of the dorm. But what will keep the growth growing will be, if you look at the table on the left, is the co-living here. So it's up 40% in the second half. Co-living it's under this brand called Collywood. So they're going to add another 60% of additional rooms in FY23. The big one will be the 400 units in Mount Elizabeth. This will be big because not only is the number of rooms going to grow, but also in Mount Elizabeth, so the rental rates should be higher. On average, the rents now is about almost 3,000 per month for co-living because there's just a dearth of supply for places to rent. So we maintain our buy. The stock is our valuation is 6 times is compared to the industry 13, and it's trading now at 35% discount to book and a yield of around 6%. Next slide. Okay, so we had the Starhub Investor Day. I know this is a very weird title, but because they call their transformation DARE Plus, so what we're just trying to say, there's more DARE, that means there's more cost being incurred, and the plus, that means the cost savings and additional revenue. I think the body have to wait until FY24. Next slide. So the key highlight for us was that in this transformation that they're going to undertake, they raised the amount of investments or spending they're going to do to 310 million. So if you look at this box here, you can see that they've only spent 75 million in FY22. So next year, this is going to be a drag to earnings because they're going to spend they're going to double what they spend in FY22. Most of the savings is because they're going to go and, what they're doing is that a lot of it is mainly cost savings. They're going to lower their maintenance costs and then the software license and so forth, and also shrink the number of physical stores. For us, revenue wasn't very visible. A lot of it was all on cost savings from what we saw. Some of the new things that they are launching for consumer, for people like us, is that there's this thing called Game Hub. So those who want to play computer games, you don't need to have the most expensive hardware. So you just play it through the cloud. Because most times you play computer games, you need to have the best hardware so that I guess so that you less latency. But with Game Hub, what you do is that most of it will be streamed to your computer or handphone. So you don't need the best handphone, best hardware. Protect Hub is more for like security, and then Life Hub is they're working with Alexander Hospital on some medical applications using 5G. It's like you wear a watch, and then if you have any issues with the health, this thing will be monitored for you through the Alexander Hospital. So these are some of the new verticals. So for us, although we have accumulated unchanged, but we think there's upside risk to the cost that our valuation, ours is mainly because we peg our valuations at 7 times. So it's cheap compared to peers, but we think there's a bit of risk here that the FY23 guidance will be weak. Next slide. So I'll move on to the weekly. Next slide. So some of the data points for Singapore, arrivals continue to be very strong, but we are still only 50% of pre-pandemic levels. So in terms of year-on-year, it's like double, it's tripled the number of people here. What is very strong in Singapore is retail sales. So in October, retail sales is up 14%. Compared to pre-pandemic, we were growing. I think retail sales in Singapore, ex motor vehicle, usually only 1%. So we're like 14 times faster than pre-pandemic. Of course, restaurants doing well. I know someone always asks about watches. Well, I mean, the latest data point is watches is still very strong. I'm not sure who's buying it, but anyway. But the supermarket is still declined about 6%. So that's to be expected. Rail is strong. SBS Rail, the number of passengers is up 55%. So this is good for SBS Transit and Comfort. Like mentioned by Terence, construction awards have been quite weak at the last 2 months. So October was down for 50%, September down 33%. So this construction awarded by government and also by the private sector. some of the things I want to run through the US. I think you saw this. So in terms of tactical view, I think the rebound in the Fed pause, that means the market pricing in a Fed pause might have already ended. We think. I think what we worry about is that the market reacted quite poorly to the PPI number, which is Producer Price Index. Is for those who don't know, PPI is what the producers, manufacturers charge their clients, or the cost that they are facing. So what has happened is that expectations was 0.2 rise, and then it went up 0.3, and the market kind of sold down a little bit. So we just worry that as we the risk reward not favorable as we enter into the 13th December, because the two big news for this week will be tomorrow when the US CPI is up, and then on the 14th when the FOMC rate decision. So we just worry that the decline in CPI may not be up to expectations. I mean, yeah, hopefully it is, but then if it's not, then we just worry there could be another round of weakness. We just want to say that there's why we think the economy may not dip as badly, the recession may not be so sharp, is because services is rising, is holding up, but goods is sliding. So you look at the services PMI, I know it actually did a bounce in November. Sorry, it's actually October. Yeah, sorry, November. Then it's September. Yeah, it bounced up, and the weakness is actually the goods sector. I mean, as expected because of the reopening and people spend more on services. In terms of things to monitor, will be I mentioned earlier, the US CPI, the US rate decision, and of course there's also ECB rate decision. We will have 3 more webinars to end the year, so do look out for it if you have time. So tomorrow, the day after, 15 and 16, and then we will have our usual Singapore strategy on the 7th of Jan. Next slide. Okay, this is one thing is clear, is that inflation in the US is definitely going to trend down. So if you look at the PPI, although it was higher than expected, but you can still see the red line is still trending down, and this will eventually pull down the Fed's measure of inflation, which is the core PCE. So this will eventually pull it down. The other thing is, one of the big services component is rent. The way the economists measure it, the US data, is that what they do is they measure on a 12 monthly basis. So there's usually like a huge lag in it. But you can see the more high frequency data, like the Zillow rent numbers, you can see that rent in the blue line is trending down. So you should expect the CPI component of shelter should eventually come off, but this would take some time. You can see when the blue line turned up, then it started to climb up. It took some time before the red line went up. So it could take like a few more months before it started trending down. But it's quite clear, I mean, inflation in the US is going to come down. Of course, the pace of it, no one knows. It's unclear. Yeah, next slide. So there's 2 more last charts. So in terms of what the market is expecting, so the market is expecting in December 50 basis point, then February 25, then March another 2. So another 100 more basis points. So we are like at the final phase of rate hikes in the US. The tricky thing now is that the market is now looking at October and December for rate cuts. November and December for rate cuts. December 23, the typo here. But what it means is that if this actually works out, then you're going to see a rally in REITs and a rally in bonds. I mean, if this actually happens, if we do get a rate cut. But the thing is that, are we going to get a rate cut because there's a recession coming, then you get a bit of pain first, or you're going to get rate cut because inflation is trending down? I mean, that's the debating point. The chart on the right is just to show you that for us, we just find it's going to be hard for the market to kind of bottom or rally from here when valuations isn't like at very attractive levels. Although it's at the average of 16, 18 times the red line, but what we're just trying to say is that with interest rates rising higher than before, I mean, 18 times isn't that attractive considering interest rates has jumped up by so much, like something similar to what John said in his charts earlier. Next slide. Okay, I think that should be the end. Yep. Okay, I think let's move on to Q&A. Can some take first? Yeah, thanks.
Yeah, well, I will take some first. There's one question on SGX. Is there any cut to SGX dividends, and is interest rates going higher impacting them? Yeah, so I think, so for dividends part, no. If you look at the historical data that they have showed, the only time they actually cut their their dividends, sorry, were in 2009. So that was during the global financial crisis. So it has been steadily going up, and I don't think they're going to lower their dividends moving forward. And is interest rate going higher, impacting them? Yep. So I think I said it mentioned earlier, that yes, the interest rates will definitely positively impact their treasury income. So we should see that going higher moving into the next few quarters. Okay, there's one about US banks. Let me try to find the question. We don't cover US banks, but just a brief summary on what happened this year was mainly they were affected by their investment banking side and the sort of normalization of their credit losses, so their provisioning. So that's what impacted them this year. So moving into next year, if the provision levels have sort of normalized, then we should see that their net profit shouldn't be as largely impacted. Yep, sorry, don't really cover the US bank, so we can't mention as much. Okay, there's one more about just a brief overview of the bank stock. So with all the talk of economy slowing and lower stocks in Q1 2023, any views on the 3 Singapore local banks for Q1 23 and update and price targets? So our target prices are all the same. So for DBS, it's $41.60. For OCBC, it's $14.22. And for UOB, it's $35.70. So for Q1, we would continue to expect that the high interest rates would benefit their net interest margins as well as the net interest income, which would definitely boost their revenue. But the slowdown in the loans growth, we can see it in the last last month's update on their loans growth. So it's falling slightly below forecast, but if you were to average it out, we would see that it's only a few basis points below the mid-single digit growth forecast, which all the banks as well as us have forecasted for 2022. So this would be a very slight impact to their bottom line. So the net interest margin as well as the net interest income growth should more than offset this slight slowdown in loans growth. So moving forward into next year, Q1 and Q2, we should continue to expect that the net interest margins will continue to increase, and this will positively benefit the banks. Okay, I think that's all for me. I'll hand it over to the rest of my colleagues. Thanks.
Yeah, let me take this one. I think, yeah, let me take this. This one is a good one. This is it's good that we get critical questions too. Like Paul Chu, you called sell on sets at 195. Is this price still valid? No. Totally missed the mark on that call. Yeah. So when I covered sets, so this was when was it? This I think was in August. Was in 2020. So some of the reasons why we called it was number one, at the peak of the pandemic, not probably the peak. It was very hard for us to, when we put a buy, it's going to be hard for us to justify why. Because then we were going to get inundated with questions that if you call a buy, then when will the pandemic end? So we just kind of we wanted to avoid that because we don't know how to answer that. So that's number one. Number two, we also thought that if it actually rebounded, even if earnings went back to pre-pandemic at that current price, the share price was trading at 20 over times, which we thought was really kind of overpriced, even if it rebounded. So and then thirdly, we thought the recovery, the losses actually ran for 3 years. So operationally, we probably got it right, but the market was willing to pay. I don't know, even if it rebounds, market's still willing to pay, I don't know, 20, 30 times for this stock, which I'm not sure why, but that was our view. So that was one of the reasons for the call. Of course, it was wrong. I mean, 195. But yeah, again, if it happened again, so long as we cannot justify why it should trade 20, 30 times PE, then we will still call I mean, for me, at least, other analysts will be different. But for me, I would have still called a sell because we just thought it was not worth buying those stocks at those levels. Yeah. Yeah, but it's good that I also forgot about desktop. Thanks for the question. Let's move on to the next one. Hey Paul, what is your outlook on local China and US market, considering the fact that people keep talking about recession and it seems to getting cash ready is to anticipate this recession is the best move? Yeah, I think the problem right now is that this recession is very well telegraphed. Yeah, I think even if you look, if you go to Google, there's one website where you can actually search for Google terms, and you can see that the word recession has probably spiked up very sharply, as high as the last recession. So what we worry about is that even if there's a recession, it's obviously going to be priced in. The bond markets have priced in with the yield curve. Maybe the equity market has not totally priced in, but so in conclusion, we think there will be a recession, but even then it will be mild one, and it will be mild because the jobs data is still holding up, I guess, and what is holding up is the services economy. So that's why we think that even if there's a recession, I don't think any collapse, the market may not collapse that much because it's really kind of priced in. Everyone you watch on TV now is already talking about recession. So that's my worry, that market's been priced in. That's mainly for the US. For Singapore, we are a bit more positive because we don't think this recession is going to hurt the Asian region, especially with China reopening. And no, sometimes you think about it, if the previous cycle, the winners like tech, all that, I'm not sure will there be a change in leadership from tech stocks, to maybe Asian stocks, and where as John mentioned, the growth rates for the tech stocks have kind of tapered down quite sharply, whereas Asian ones could, on a relative sense, could be even better. So I mean, that's my must recession happen for sure. Even if it doesn't, most important, there is a slowdown. So there's definitely a slowdown happening, but a lot of it is on the goods sector rather than the services sector. Yeah. Okay. Hi, your update on Jabfa. We don't cover Jabfa, but we were at the briefing. So for those who don't know what Jabfa does, so Jabfa is they trade on grain. So they sell on grain, feed meal, you call it feed meal. Then they rear chickens, of course in Indonesia only. Then in Vietnam is swine. So the update for Jabfa is that they are going to IPO their dairy farm, which is the third business in Hong Kong, and then do a distribution in specie. For us, I mean, if you look at Jabfa for many years, you know that this stock is extremely volatile, and the best times to buy is when the results are the worst. And I think the results have been pretty weak recently because of the high feed meal cost, which is wheat and which is corn, and so forth, and soy, and that's why the earnings has been weak. But all these things will tend to cyclically will come down. So I think I don't know, for me at least, Jabfa looks attractive because it's when it's the worst, it's the best time to buy because it's so cyclical. Yeah. And usually when things are weak, it's usually a bit like almost like what happened to sets. When things are down, it's very hard for the analysts to call a buy when they don't have much visibility. Because sometimes for us, as analysts, even though we think Jabfa might bounce, if we don't see anything there, it's hard for us to call a buy until we see something. Then we got to prove it, then got to write a long story and explain it. Yeah. So that's the challenge sometimes we have as an analyst. We have to see it before we can actually make that particular call. Otherwise, it's hard for us to justify it. DelMonte good result, but is price not moving? Do you miss something? I think I probably didn't miss anything because I'm the only analyst that covers it. But I think maybe it's the debt. I think that my only sense is that maybe the high gearing is the one that maybe puts investors off. But like the whole Singapore, everything is also cheap. So, but I think that could be the only thing. What could turn it around is that if there is an IPO, I mean, they've clearly messaged that they want to IPO the US operations. Yeah. But one other thing why we like it is that apart from the gross margins hitting record levels, is the fact that you can only do it if you have, I guess, a relatively strong brand. So if you look at the history of DelMonte Foods, the US operations, when they bought it in, I think 2013, sorry if I'm, or 2015, or sorry, 2017, I think. I didn't slip my mind with the date, but when they bought it a couple years ago, the US operations wasn't very focused on brand. They were mainly like outsourcing, like a contract manufacturer for canned food. Like when if Walmart wanted canned food to put under their own brand, the house brands, they would just ask DelMonte US to do it. But since the new management or the second generation, the new management came in, they focus a lot on brands, and it's only with brands that you can raise price and you can get better margins. And they've got a lot of new products. I think if you go through their slides, they have lots of new products. So that's the one main difference. Yeah. The other overhang is maybe Philippines. If Philippines rebound, then this stock would be on autopilot. I mean, that means almost all divisions will be doing well. But maybe the debt, I would say, if I had to say something, probably is the debt that concerns people. Let me just take one more, then I'll pass on to the rest. Is Propnex and APAC Realty a buy or sell? As the fixed, the dividends growing, what is the expected performance of this sector? So for we need to cover Propnex because we just think that investors will probably just gyrate towards the leader. So for Propnex, what has happened is that we thought this year the earnings would drop, but actually we think earnings could stabilize. Although property transactions has collapsed maybe 30%. But why? Because they've done really well in resale. One of the strategies Propnex does is that they actually have I guess everyone has it, but they probably more concerted effort in terms of the database. So they, although we can't see, but they monitor the number of, so resale did very well for them. Because what happens is that they were tracking all those units that were bought 3 years ago, and then because after 3 years you don't have the sellers. I think 3 years. After 3 years, you won't have the seller stamp duty. So once that is done, then they focus on all these sellers to try to prompt them, or at least do a lot of marketing, and not prompt, but at least put a lot of marketing efforts to see if they want to sell their units with the kind of gains that they had, if any. I'm not sure, but that's one of the strategies they did. Next year we think will be better as there are more new launches next year, because next year I think there should be 11,000 compared to this year was 7,000 off the top of my head. So next year will be better. The only thing that holds me back from Propnex is that they are still a very Singapore-centric company, so there's something to remember. After Singapore, there isn't really, they are not very big, or at least big enough in countries outside. So their means is going to be only Singapore. So after that, growth is going to be a bit more mature. But this is a stock that they want it to be a dividend yielding stock. So I think they should be paying maybe at least 5 to 6% dividend yield. Yeah. Okay, I think I hand on to the rest before I continue. Thanks.
Yeah, so I'll answer some questions. How much should interest rates decline before we see an improvement in REITs or property counters? So for this, I can't really say, but then it also depends, like Paul mentioned, what's the reason the interest rate starts to decline or pivot? Is it because of recessionary concerns, or is it because the inflation problem is has been settled? So of course, if because of recessionary concerns that the Fed actually kind of pivots and start reducing the interest rates, then of course it might not be a good thing for REITs as well. Yeah, so I can't really say how much in percentage terms should the rates decline before you see any improvement in them. Okay, the next one is recent article on US properties retrenchments at tech industry and workers not returning to office. What is your view on prime US REIT still buy with a target price of 88 cents? Oh, okay. So first of all, there are retrenchments in the tech industry, but for prime, there are top 10 tenants. None of the top 10 tenants are in tech. So 40% they have 40% of their portfolio value is actually from the top 10 tenants, and none of it are in tech. And also furthermore, I heard from one of the REITs, US listed REITs, that the companies are actually some companies are actually using this opportunity to kind of retrench their workers quietly, like under the table. Like if they ask the workers to come back maybe 4 or 5 times a week, and then if you don't come back, then they might just use this opportunity to say, oh, you don't need to come back anymore. if you don't want to come back to office. Yeah, but this is just what I heard. And yeah, it's just like an under table way to start retrenching people. So because of that and because of the labor market tightening also, that's why some of the workers are kind of worried. So yeah, and according to JLL also, the number of people are starting to go back to work also for even in the US. Yeah, and it so happens that a target price of 88 cents is actually about 1 times book also for Prime. So yeah, those are some of the reasons why we still have a buy call on Prime. And they also showed that they have portfolio resiliency. Like even though one of their tenants left, the one at Western Square, and they managed to sign new leases to kind of maintain the occupancy at that level at 89.6%. Can you kindly comment why AIM's APAC REITs is retreating so hard in the last few weeks? I don't see any AIM's APAC REIT specific news. So in my opinion, it's just a general broad market weakness in the REITs, which is why it's retreating. Yeah, I don't have any. You do have coverage for AIMS also, so yeah, I don't have much to add other than that. Please comment on Manulife's strategic review and what can be the most likely options going forward. What unit holders should watch out for. Yeah, so for Manulife's strategic review, they've undergoing 2 things. One of it is the hotelization of their portfolios. Like they will refurbish their assets, making it look like it's still an office property, but they may make it look like a hotel. So like when you go into to work every day, then you see like, wow, very nice lobby, and then you have maybe a rooftop bar, etc. So this will help to kind of boost the expected rents by about 30%, this hotelization. So they're doing it for one of the assets, Peachtree, next year. So those are, and then this is one of the plan. And then another one is the flex space that they are working together with JLL. So it's a flexible space, but they also expect to get about 30% rental increment from that. And then for the other strategic reviews, like maybe divestment and others, they haven't really said much about it. And of course, we know that divestment and acquisitions in this current market is quite hard, because especially for acquisitions, if the Fed rates are almost 5%, 4.5% is really hard to make any accretive acquisitions. Yeah, I think that's all for me for now. I think I'll hand over to the rest of my team.
Yeah, just takes out the questions in the queue. For Sembcorp Marine, how the reaction can be if, sorry, let me just read it again. Sembcorp Marine, how the reaction can be market if vote down. So I think it's a bit hard to tell how the market will react if the vote is down. Mainly, I think the positive factors for Sembcorp Marine will be that if they don't have to acquire Keppel Corp, then there will be a lesser dilution to the share price. Then we could see Sembcorp Marine, a positive reaction to Sembcorp Marine. On the other hand, for us, it's a little bit mixed, right? So on the other hand, if the deal is voted down, it could be a negative for Sembcorp Marine, because Sembcorp Marine has rallied in the last couple of weeks after the announcement of the improved acquisition terms with Keppel Corp. And during their third quarter results update, they actually mentioned that the outlook for the oil and gas industry continues to be more challenging for them, and the third quarter results were bogged down by higher operational costs and that drag overall profitability. So we think that it could be more negative for Sembcorp Marine, especially if the deal is voted down. Between SETS and SIA, which do you prefer? So for us, between both of these, we prefer SETS. The main reason is because in this current climate where it's still a little bit uncertain in terms of the trajectory, SETS as a aviation service provider is more agnostic towards the airlines, because with SIA you got a lot more competition. You got to compete with the other airlines like the Middle Eastern airlines as well. But for SETS, because they're just a service provider, so it doesn't really matter. It just depends on the throughput at Changi Airport. So between both, we prefer SETS, and that's why we have a coverage on SETS now. Noted the good performance of CDL. Why is Guaco Land not moving? Yeah, so the reason why we don't have coverage on Guaco Land, but the reason why Guaco Land is a little bit flat now is because they don't have their land bank is not replenished at this stage. They are looking at a couple of different areas, but they haven't committed to any new sites. So other than Lentor Modern, which was just launched about 2 months ago, they don't have any new projects in the pipeline, and the mood is also a little bit cautious with regards to the acquisition of new land bank. So that's why it's still a little bit flat now, in the absence of any new project launches. Next question, with Keppel and Sembcorp Marine merger, any target price of Sembcorp Marine post Keppel O&M acquisition? Yeah, no, we don't cover Sembcorp Marine, and the reason why is because it's very difficult to get a read on how their financials will perform for the next 1 to 2 years. So for instance, one example that we can share is in the first half of 2022, when management was giving some guidance or outlook on the future, they actually guided that second half 2022 will be a very good year for Sembcorp Marine, mainly because of better contracts and the improved manpower situation in the industry. But in the third quarter 2022 the results disappointed, and what they say was, oh, now the outlook is even more uncertain, and this was because of certain challenges that they didn't manage to anticipate. So for that reason, it is a little bit more difficult to try to project the forward financials for Sembcorp Marine. But after the KOM acquisition, if they are able to provide a clearer direction, then we will possibly explore initiation. Please comment on ST Engineering. Though analysts mostly favored, its price has come down quite a bit. Is it an opportunity to add or buy? Why, of course, is share price drop? So maybe let me take the second question first. The one of the reasons why the share price have come down, there are two reasons why the share price have dropped significantly. The first was because they lost one contract to another US company. It's a defense contract in the US, and because they lost the contract, there was a bit of a share price correction. The second reason is because of the higher interest rates. Now, about half of ST Engineering's debt is floating. And because half of this debt is floating, their US debt, because of their commercial papers, the interest rates has surged in line with the rising interest costs. What that means is that that has about 9 to 10% impact on their bottom line. So these are the two reasons why the share price has dropped, and without any clear trajectory in terms of what Paul mentioned earlier on about the terminal rate of the Fed fund rate, then there could be further downside to the earnings if the commercial papers continue to re-rate upwards. But is it an opportunity to add or buy? We don't have a rating, but in terms of our outlook for ST Engineering, we say it's quite favorable. One of the reasons why we say that is for two reasons. Firstly, they upgraded their defense business outlook in the third quarter of 2022. The second was management tried to in their third quarter results, what they say, they are looking to reduce the amount of debt on their books. They didn't say by how much, but they will try to reduce the debt. So they will reduce the interest drag on their earnings. So if they can fix that part, then the overhang on the stock will be reduced over time. So they are looking at it closely now. So is it a good time? Yeah, the outlook has certainly improved compared to the last few months. Let me just scroll down to see if there's any more. There's one question here. I don't know if it's a TA one, but let's take it. What is target price for Genting Singapore and SETS? Right now, target price for SETS is 308. But let's leave the question here. Hi Terence, will Keppel Corp share price adjust lower post Keppel and Sembcorp Marine merger? Thanks. Yeah, that's a good question. Yeah, so the short answer is yes. The reason why is because there'll be a capital distribution that has already been approved by Keppel Corp shareholders in the EGM last week. So that capital distribution is about $3 of their book. So the share price will automatically adjust from that capital distribution. But we believe that there could be a re-rating as well after accounting for the adjustment, because the group will be leaner and also less capital intensive as well. Yeah, I think that's all for me. I'll hand back the time to the rest of my team.
Yeah, okay. Let me just take on these two, then I'll pass it back to you, Zain. I know there's still lots. Did anyone put the Chip Ing Sing, or is it I accidentally typed answer? Yeah, okay. Do you think it's a fair deal to accept cash offer for Chip Ing Sing at 75 cents? If not accepting, is the shares be delisted? Yeah, I had to go and check the circular anyway. So they have plans to delist it. Yeah, so this is their intentions to delist. Is it a fair deal? I think Chip Ing Sing is, based on the recent NTA, is probably at 25% discount to book. I think the book's $1. Anything below book it's probably not a good deal, I guess, because there's also development profits that is not accounted for. But having said that, I think the last two privatizations, Roxy Pacific and Singhai was also at 40%, was an even larger discount. So it's a 40% discount to book. So the IFA is definitely going to say this is probably a reasonable price. Yeah. But again, yeah, but that's the problem with a lot of the property developers. A lot of them got privatized at 40-50% discount to book. And once you have this type of precedence, it's going to be hard it's going to be hard for it to change. So you can imagine if the offer was 40-50% discount to book, and normally the offer is already 20% or 30% higher than the previous price. So you can imagine those shares were trading at maybe 60% discount to book. Yeah. So yeah, that's the problem with the stock market. The market here doesn't really recognize developers, always giving them a discount to book. Let me just answer this one more. Then after then I'm panning on to kindly your TA and FA take on nanofilm till first quarter. Let me just give you the FA take. So for those who do not know, on nanofilm's three main segments is a coating. So they do carbon coating at the vapor disposition, carbon coating of parts. The three parts is, the big customer is customer Z, which I think the whole world knows is customer A, Apple. The second one is their cell equipment, their vapor disposition equipment, and the third that they do is the third business they do is for optical lens. So what they mentioned in the results is that customer Z won't perform well because of the shutdown. The equipment won't do well because customers are cutting orders. The one that's only do well is optical lens. So fourth quarter will be weak. So maybe first quarter there could be a mild rebound. That's why the share price is up, because because of the removal of lockdowns. Yeah. So this stock is only rebounding because there is because Apple is recovering from the shutdown. But again, I'm not that excited about this company. I think it's only maybe in the end of next year when they start working on the new EV projects for the battery packs. I think that will be the main growth driver for them. Until then, I don't think there'll be much growth for this company. At least that's our own take. We don't cover it. I'll hand it over to you, Zain.
Okay, thanks, Paul. Let me share my screen now. Okay, so I'll begin with nanofilm. So for nanofilm, currently it's still in a downtrend in this channel over here. Traded out of it recently, and currently looks like it's forming an uptrend channel over here for now. But for now, I think there might be some possible resistance acting on it, because when we use a swing high of 187 over here and the low of 118 over here, it has reached about the 61.8% retracement mark around the 160, which we just hit today. And also, we've also retested this channel support over here, which might for now it might act as some resistance for now. But for short term wise, it's still in this uptrend channel for now. So short term, we might still see some bullish movement after maybe like a possible retracement over here. Okay, move on to CoverDelGro. Okay, CoverDelGro, still nothing much going on at the bottom of this channel over here. So currently, I think there's a possible consolidation that's taking place for now. So the support is around the 123 level, while the resistance is around the 126 to 128. So should we break out either way? I think the next support down there will be around 120, which was a swing low created last time back in 2020. And then if we do break out of upwards of this consolidation, I think the first resistance to look out for is around the 130 mark, which is a previous resistance back over here in October this year. Then Jardine, CNC. So this one has been after it broke down of this big uptrend channel over here, right? It has been trending downwards in downtrend formation with the lower highs and lower lows. So also key thing is that recently it broke this 2950 horizontal support over here. So I think the price there could be some more further downside to come. Possibly retest this next support level last time. So that last time it made a swing low around the $26 level over here to about 27.20. So there's a chance that we are quite near this support zone already. So there's a chance that we can come back into this zone again. Then for now, the immediate resistance is the strong one is at the $29.50 level over here. Okay, then Thai Bev. Okay, Thai Bev, recently it turned back to bullish. So previously there was a support zone last time over here around the 615 to 640 zone. Then we broke down over here. Recently we managed to stand above it again. So for now, it hit a swing high of this 685 resistance over here. So for now, there might be some short-term resistance acting on it. If we do manage to clear 665, I think there's a good chance that it continues to hit to the 70 cents to the 71.5 cents stronger resistance zone over here. As for the support wise, I think the first immediate support is around this 650 mark over here, which was the swing low last week. Then a lower support will be around the 630 level over here, which was a horizontal level that we broke out from, as well as a previous support zone over here. So that's for Thai Bev. Then moving on to the local banks. So DBS has been showing some weakness recently. So share price has been coming down, and currently we are at this level. So previously this $33.40 horizontal level over here was a resistance that we broke out from. So currently what we are doing is a retest. So there might be some bounce that's coming in for now. If we hold at this level, then the resistance will be around 34.30 over here. But if this bounce fails, right, which means we reject this channel resistance over here around the $33.70 mark, I think we could head down to the lower end of the channel over here to retest this green color support zone. So the support is quite strong around here from 31.50 to about 32.30 level over here. So let's see how it goes. Whether it managed to hold at this $33.30 level over here. And OCBC has been moving more of a trending downwards a little bit, but still moving in more of a sideways pattern. So this $12.20 level over here has been holding as a short-term support, while the highs have been declining. So for now, the resistance will be this swing high over here around the 1250 level. Then one thing to know is if this support gives way, then I think there's a chance that we do retest the next swing low around the $11.90 to about $12 level over here. Okay, then for UOB, after we tested this swing high of about 31.30 over here, currently is doing like a bit of a sideways trading for now. So I think I expect that to continue for now with the support around the $30.50 level and the resistance at the $31.30 mark. Should this $30.50 level not hold, right, then I think we could test the lower end of the support zone around here, which is near the $30 mark, which is also a psychological level. Then if you do break out of this 31.50, the next target should be able to reach the year high level at around 31.97 in February this year, near the $32 mark. So for now, looks like UOB is still the strongest one, followed by OCBC, then DBS. Okay, net link. So this one has been on the downtrend recently, and then it did a bounce over here. So possible ascending triangle pattern in the forming up, but still need some time to confirm this. So for now, it might have some short-term resistance around the 85-cent mark. So it was a previous horizontal support level previously, and then we broke down a bit. So currently looks like we are doing a possible retest. Then also, if the resistance will stretch to about 88-cent mark, which was a swing high last time. And for now, the support-wise could be near this swing lows mid, which is around the 82-cent mark over here. Okay, then Maple Tree Pan Asia. So this one looks like consolidating for now in a possible descending triangle pattern. So the support is this horizontal line 165. So then the resistance could be around the 170 mark, which is this horizontal level, as well as the downtrend line over here. So let's see some more time whether it breaks upwards or it managed to wait, or whether it goes down. So currently this loan is still consolidating. Okay, then 579. Beijing Dingdeng Clean Energy Company. Okay. This one looks like for most part of the second half of this year looks like it's in a like range trading pattern over here. The strong resistance is around the 180, 190 level. Possible double bottom formation for now. Then currently short-term wise is on a bullish uptrend given by this uptrend line over here. So I think if this trend line managed to hold, I think there's a good chance that we test this swing high resistance around the 190 mark again. As for the support now, I think it's around the 170 level over here, which also will match with this trend line support. Okay, we'll it's like it's taking some time. Okay. Okay, Wilma, looks like in this range pattern, the resistance is around the 417 mark. Today looks like we tested it again over here. So I think If you do manage to break out, then the next level to look at is around the $4.25 mark over here, which was previously 2 times swing high over here. For now, looks like there's a chance to break. Looks like there's a good chance to break out, given that it's tested the highs quite a lot of times, and the lowest over here around the $4 mark has been holding for a while now. Okay, then the next one is Singtel. The Singtel, after hitting the double top over here, looks like currently doing a pullback. So in this pullback channel over here, there might be some support coming around 260 if it follows this downtrend channel over here. And for now, the short terms, some resistance might be around the 264 to about 268 level. So it was a horizontal resistance over here last time, and then so horizontal level 268 was over here where we broke down over here to test this channel support over here. So that's for Singtel for now. Then First Resources. In this one, looks like the previous resistance zone over here from around 153 to 158 over here didn't manage to hold. So after it came back within this channel. So for now, I think the next support is around this 144, 145 swing low level over here for now. So I think we are around here already. If this gives way, then I think there's a chance we could come down to the lower end of the channel to about the 130 to about 137 over here. For now, then the resistance will be this, possibly this downtrend line over here, and this old resistance zone. So that's about 153 to 159 over here. Okay, then iFast has been on a strong run. So after it reached the previous support, now looks like some resistance might be acting on the stock. Possibly flat consolidation over here. So this triangle. So it looks like need more candlesticks to confirm the next price action. And the support for now is around the 580 mark. Then while the resistance is at the near the $6 level. Okay, then AEM. Okay, AEM. So there was this trendline support over here last time, the key support. Then we broke down over here. So recently we did manage to do a retest. Afterwards, we saw some pullback over here. So for now, short term wise, still bullish as long as if we can hold this uptrend line support over here. So today we are like at the edge of it already. So some risk involved. So around this 370 level must hold. If not, we could see pullback to the next horizontal level around the 345 level over here, which was a previous swing low back in late November. As for resistance wise, it will be this swing highs over here around the 380 to about 390s level over here for AEM. Okay, then I think I'll cover three more, then I hand over my time back. Okay, for Hong Kong, Alibaba, so the still remaining bullish as it's still staying above this 83, 84 neckline resistance that we broke out from. Okay. Then currently looks like might be doing a bit of a sideways trading for now after it hit the 50% retracement level of around $91. So when we use a high of 122 over here and a low of $60 over here. So if we do manage to break out, then the next level to take note is around the $98 mark, 61% retracement. And also there was a previous swing high over here around the $97, $98 mark. So that's the next level for Alibaba. Okay, then Baidu also still looking good after it broke out of this consolidation over here. So using the high of 148 and the low of 74 over here, what is done is that it hit the 61.8% 119 over here. So there might be some resistance at this level, given that it's a confluence of this Fibonacci level as well as a previous swing high resistance over here. So there might be some pullback to possibly form a range over here. And the support, immediate support could be around from 106 to about 111, these two swing lows over here. Okay, then 398, Bank of China. So Bank of China, this one looks like a short-term rebound after a downtrend over here. So currently looks like possible trading in this possible uptrend channel for now, where the resistance could be around this 277 to about 282 levels over here, this red color zone. Then support-wise, I think horizontal support could be from this 267 level over here. Then if it breaks down of this channel, then I think the lower end is around the 260 level over here. So that's for Bank of China. Okay, I think I'll pass on my time to the rest of my colleagues to answer some of the other questions.
Okay, we're trying to, still got so many, we're trying to finish as many as we can. So do you ask Zoom why meeting could not start the quarter? I really didn't. We tried to use our time to ask the fundamentals. Actually, if any of the attendees should have actually asked, but we didn't ask. I don't think, John, do you ask that? Yeah, I don't think John asked that. But admin, just as a reminder, everything will go back to 11 o'clock. So hopefully nobody will ask us again why the meeting start at 11:15. So I mean the meeting will now change to 11 a.m. Why Golden Energy no news? My guess is they're just going to provide with the circular, the circular, the offer document. So maybe that is going on, and also based on the current price, as you know, the takeover offer is cash, all cash or with the Indonesian GEM share, the GEMS. The cash offer is 824 based on the current exchange rate, and also the shares and cash is value is about $1. Just for those who want to, who just want to know, but there's no news. I think they probably need to dispatch the document, I guess. Okay, I'm not sure what's the link. Oh yeah, can't find any follow-up report on stats after that call. Which happened? Which call? Is it talking about the sell? Oh, after the sell call, we change it to neutral. After again, we just bewildered why investors still liked it in the middle of pandemic. So, and also because of resources, so we dropped coverage on it until Terrence resumed it. Yeah, because it was trading at, like I said, about 20 times PE, 20 plus times PE, more than 3 times price to book. And that's assuming the recovery happens, and at the time, it was very hard to call for the recovery. Yeah. SRS investment time, where to park that 15,300. Yeah, I think for us, and also the same question, if you had 10,000 spare cash December, which locally listed would you buy? Conversely, you need to raise. I think for us, we at least for me, I mean, the one that we like is actually some of the US REITs. I think, like what Darren mentioned, the yields about 13-14%. Just to give you a bit of backdrop, what has happened, okay, why the US REITs dropped until so much. I think the first round of hit to the US REITs was because, of course, interest rates ran out, like everybody got hit. The second thing that happened for the US REITs, especially the office ones, was that the work from home was worse than expected. I think because work from home in the US was supposed to be quite advanced, because it was already like 10-15% penetration, but it hurt quite badly. I think it was worse than everyone thought. And then the third reason that hit them, apart from all this news about the tax, which is not true, they already mentioned it, there's no impact to them, was also, like mentioned by Darren, because of the cut in occupancy, they had to do this hotelization. Basically, got to pay more money to make the officers look better. Otherwise, the employees not going to come back in. So because of that, they have to spend more capex. So as a result of that, you're getting this wave and wave. But for us, what we also think is that some of these stocks are already trading at, correct me if I'm wrong, Darren, but at least 40-50% discount to book. Of course, the book will come off a little bit. Maybe you can assume 10-15%, but even then, these are trading at distressed valuations. Of course, everyone will say that, oh, because the outlook, yeah, but that because of that, that's why you're getting a 40-50% price to book. And for commercial properties, so at least you have some that visibility. So for us, the US REITs, I think, is what we like. And also, as we enter into 2023, when economic conditions are slower, and you know that Fed rate is undergoing the last phase of interest rate hike. So REITs, we think, are quite well positioned, but we of course prefer some of the overseas ones because the yields are more attractive. Which stock to sell? Yeah, I'm not sure actually. Really, yeah, I don't have any specific names. I'm not sure what you're holding. Yeah, sorry for that. Yeah. So these are the ones that we have a bit more conviction. What do you think of Tuan Sing fundamentally and technically? Quite close to here. We haven't covered Tuan Sing. I think Tuan Sing came to one of our presentations before, webinar. We'll try and get that in next year. But I think Tuan Sing's big bet is two things. Is the Batam redevelopment they're going to, and also there's going to be a major redevelopment of one of their properties in Australia. They're going to do a major conversion, and there's going to be a big uplift in the NAV. But that will be, I think, maybe 1.5 years time. The next one they're going to do is Batam. So again, we are like no insights in whether these two projects. We can only tell you what is going to drive the share price is whether the Batam properties actually will do well, which we have no particular idea. Hi Paul, with Olam recently securing 2 billion bridge loan, is it incurring additional interest costs? What is your take going forward? Yeah, I think for us was that when number one, commodity prices rallied, the earnings didn't move much. I think it went up maybe I think 7-8%. Of course, it was good, but record high in commodity prices. So the worry you're going to have again is that their net debt is about 12 billion. Every year, Olam incur about 600 million US in interest expense. So I mean, can you only imagine you get 12 billion, then if interest rates are going to increase, right? I mean, everyone knows that. So if you assume 2 percentage points, so they're going to have at least another 200 million of interest expense. I mean, just on paper, not it doesn't mean they're going to get that, but so they're going to face a big headwind because in the commodities trading, they take on a lot of debt. So debt to me is going to be the big headwind for them. So it's a bit more challenging to own a commodity trader, I guess, when interest rates are rising so high. What's the US dollar expected next year cost US fixed deposits better than? Sean, you want to take this?
Sorry, I think my internet's lagging. Hold on.
Question is whether US dollar fixed deposit or Sing dollar fixed deposit. Okay, you have a you take your time. When you're ready, you let me know. Then we try and clear up everything. Okay, thanks for explanation. You got it? You can. Okay, let me just continue. Okay, thanks for explanation. Why no follow-up reports if your call is well supported? This is about sets again. Yeah. We kind of when you get it wrong, right, we don't understand why investors. Like I said, mentioned, we didn't understand why investors like the sets at these levels at that time. I mean, of course, now we have a different view now that the pandemic is over. So at the time, we just couldn't justify. We had no reason why we should buy this at 20 times PE. Not at the level and when the recovery has happened. Yeah. Why sets? Sorry, I'm not sure which one. Why sets? Yeah. Yeah. I mean, if you want to follow, you can ask. Update on Maple Tree. I think we can. Yeah. Thanks, Paul and research. Yeah. Thanks. Thank you. Yeah. Merry Christmas. Yeah. Thanks for that. Darren, you want to take the rest? The Capital Corp. How about Golden Agri? Yeah. Sorry, Golden Agri. Yeah. No updates for me. Sorry. Yeah. Glenn, you want to do the savings thing if you want? Yeah.
Yeah, the Capital Corp.
For DC REIT and Maple Tree Long.
Yeah, how is Capital DC REIT going? REITs dividends going forward? Yeah, so for Capital DC REIT, assuming everything goes status quo, I mean, it's also quite tough to do any like inorganic acquisitions and such, and divestment. So if everything goes status quo, their dividends going forward is about 5.5%. So it's about slightly under 10 cents per share. Yeah, and Maple Lock we don't cover, so actually I don't have much to say for Maple Lock. Yeah, but they did have some good performance in their third quarter earnings. They had a contribution from couple of acquisitions that they completed in second quarter, like the ones in Malaysia, and in the second quarter, so cause their financial year end is slightly different. So their second quarter, which ended just recently, their DPU was up 3.5% year-on-year, and their portfolio occupancy is relatively stable at 96.4%, with average reversions of 3.5%. So yeah, it's relatively stable, and they're also quite hedged their interest rate. At 70% of their debt is hedged. So yeah, I think that's all I have to say for Maple Lock. Because we don't have coverage. Yeah, sorry about that.
Sorry, Paul, you said something about savings. I don't see the question. Which one is it?
Oh, you wanted to no, why US dollar expected next year? What is the US dollar expected next year? Because US fixed deposit is better than SGD to place, right? To place US dollar. Yeah.
Okay.
Okay. Let me just give you our quick view on the US dollar. So again, take it for what it's worth. We're not currency experts, but we think US dollar would is most likely is going to weaken next year, because I think it's for there's two reasons. I mean, we always say that the interest rate differential is narrowing because the US Fed is going to stop raising rates, whereas the other countries are raising. So the interest rate differential, and the secondly is the US dollar is a major oil exporter, so it's also like a bit of a proxy these days towards oil price. So because of that, and also the third reason is, in general, I not really have a strong understanding, but in general, investors still view it that when global growth could be picking up in Asia and so forth, so they tend to gravitate towards non-US currencies. Yeah, I mean, yeah. But for me, it's mainly the interest rate differential and the commodity prices. Yeah, because US has now, I think, even when people talk about strategic reserves, the US may not need to actually replenish so much with strategic reserves because they are now like oil exporter, right? So don't need that much unless you're an importer. Yeah, I hope that explains it. Yeah, unless Sean, you got anything else? Is it better SGD or put money in SGD deposits or US dollar deposits? Yeah. Okay, I think yeah, go ahead.
I think like what is said for the US, because I don't really cover like US fixed deposit, but I think like we have mentioned in terms of commodities and what, whereby the US, the currencies will be dropping in the near future. But in terms of Singapore fixed deposit, yeah, I think it's still within the 3.9 to 4% range. So I guess, yeah, that's about it. That's what I know. Yep.
Okay, thanks. I think the rest of the questions we probably don't, unless Zane, okay, most of it, like, how about Golden Agri? Sorry, I don't really have much from Golden Agri, because sometimes some of these companies we don't really follow, and then we don't, and likewise for Rex International, they don't give any briefings. They Golden Agri does, but we couldn't really attend. And then for Rex International, they don't give briefings and so forth. Yeah, I'm not sure why. Maybe they think everybody loves their stock so much. But anyway, yeah. Okay, I think with that, I don't think yeah. So I think we answered most of it. So sorry, some of it is just sometimes we don't have answers for. Yeah. Anything else, Zane? You want to add, or?
Nothing else from me. For the TA questions, I think you can post on either the Telegram group or the P3 app. Then I'll try to answer them. Yeah.
Yeah. Okay. With that, this comes to the end of our webinar. Hope we'll see you the 9th, I think, the 9th of January. And thanks everyone. So wish everyone Merry Christmas and Happy New Year. Hope everyone have a good year ahead. Yeah, especially a good celebration the next couple of weeks. Thanks everyone and take care. Have a good 2023. Thank you.